Let's have a big picture discussion and kick off this week. Joining me from the Schwab team, Michelle Gibley is the Director of International Research, and Charles Schwab and Cooper Howard's the Director and Fixed Income Strategist at the Schwab Center for Financial Research. Kicking things off where we left off from last week, Michelle, we talked on Friday, kind of going back through the timeline of how we got the dollar to fall apart and a 50 basis point cut. Now, as we start a fresh week, what is your mindset thinking about where the surprise comes from central banks? Like looking around, what's the most important factor?
Well, I think the Fed joining the rate cut party really is important for global central banks. It kind of gives them more leeway to cut. It's particularly important for currencies that are pegged to the dollar or for very open economies where exports are important. So that'll be illustrated this week by the Swiss National Bank. They're expected to cut rates by 50 basis points. That'll be their third cut this cycle. They only meet quarterly. And then, last week we had quite a few central banks cutting in conjunction with the Fed. And that would be, central banks that peg to the dollar. So Hong Kong and the Gulf countries, such as Saudi Arabia, Bahrain, UAE, and Qatar. This week, other central banks, Mexico is likely to cut rates. That'll be their third cut. And in 2 weeks, we could get India make its first rate cut, and China could also cut a range of rates beyond the 14-day repo rate that they cut last night. And so for emerging market countries, when the Fed cuts, it reduces their concerns about capital outflows if they went at it alone.
The potential for everyone else to really, join in the party, if not already in it. Love the list. I guess I didn't even realize how long it was. Do all those other central banks lowering their own rates change the dynamic for bonds, Cooper, or will there still be plenty of demand for treasuries to keep yields low?
I would suspect that there'd probably be plenty of demand for treasuries. I mean, we are the largest market in the world, so I don't think that that's going to change anytime in the very near future, or probably anytime in the longer term future. So I don't really see that changing too much, Oliver. So I think that there's still going to be fairly significant demand for treasuries. I think also, given the slope of the yield curve, rolling out of cash and adding some intermediate term bonds, given that you aren't giving up duration on that, or you're adding duration, but you're not giving up yield on that, I think that can still be attractive. So I don't see really any major concerns with demand at this point.
Cooper, one thing we heard from our guest at the top of the show, Mark Lopresti, was about cash on the sidelines, and that's a description I've contested somewhat in the past, especially when the Fed was keeping rates high, because your money market funds, your CDs were giving you a nice return, and people were very purposely in there, part of that kind of T-bill and chill trade to some extent. How much of that lingers? How much of it is dissipated in your mind?
I still think that it lingers out there. And I think what we saw, especially with the inverted yield curve, Oliver, when we spoke to clients, we know that there's three main asset classes for building a bond, or building a portfolio, I should say, There's cash, there's bonds, and then there's equities. And we know that a lot of our clients that we spoke with used part of their cash as an allocation, used part of their bond allocation to shift towards cash. And the reason being is you got a higher yield on that. But I think there's still this notion that they can continue to get a higher yield on that. We do expect that the yield curve is going to continue to steepen. So for those clients who have been sitting in cash or a large cash allocation, Oliver, I do think that it's probably prudent to start to add some intermediate term bonds. If we're looking at attractive yields, I think that there's a couple places that offer attractive yields. If you look at the investment grade corporate bond market, that appears to be a relatively attractive trade at this point. Also, municipal bonds, the tax adjusted yield, if you're an investor in the top tax bracket, that can be 6.5%, depending on what your state tax rate is. So even though we've seen a little bit of a pullback in yields, I still do think that there are attractive opportunities, but yields on cash, given where the Fed is going, they're likely to move probably lower soon.
Yeah. Okay. Good point. Well argued. Michelle, thinking about back to the international discussion, what you said about China, I feel like worth circling back on, just because still on the year, despite seemingly continued disappointment in the Chinese economic situation, the big cap stocks have done all right. I mean, they're basically on track with U.S. stocks and FXI. So if they do actually start cutting across more, benchmarks, What effect does that potentially have, and to what degree might they take measure?
Yeah, I think, it's probably a little surprising to people that Chinese stocks are kind of quietly seeing some signs of life, and same for emerging markets in general. I think there's a lot of negativity toward both of those. And, China's economy continues to disappoint. And we believe policymakers really need to do more to support consumer confidence and demand, and particularly with regard to the property market. Tonight, we'll get a joint press conference by all three top financial regulators. This was kind of announced on short notice. So there might be some hopes in there for, something bigger, but I would be surprised if we get some kind of bazooka type stimulus. But like I say, expectations, valuations are low, so we could see more of a short-term bounce. Whether it can be a multi-month gain is, in my opinion, going to need a big change in China's attitude toward avoiding economic downside risks.
Okay, good stuff. Some fun things to watch here. Seems like when we move outside the hyper spotlight, the laser focus of FOMC week, there's a lot of fun subject matter here for us. Thanks, guys. Michelle Gibley, Cooper Howard.